Ever looked at your retirement account and thought, stocks and bonds are good, but what about something real? Or no, something maybe you could, I don't know, actually hold. Perhaps you've wondered about diversifying with physical gold inside your IRA. If that sounds familiar, well, you're in the right place. Today, we're really digging into gold IRAs. But not just the shiny metal itself. We're focusing on the crucial IRS tax rules and regulations, the things that, make these accounts actually work. They offer unique benefits, sure, but let's be honest, the tax stuff can feel complicated. Understanding it is absolutely key to, well, getting the most out of them and, maybe more importantly, avoiding some nasty surprises. We're drawing on research from Doug Young for this. He's a financial markets researcher, knows his stuff on gold IRAs, and his insights help cut through the jargon. So our mission today, simple. We want to pull out the most important bits about gold IRA taxation, contributions, distributions, all that stuff, so you can feel genuinely informed. Okay, let's unpack this.
Yeah, it's a fascinating area, isn't it? How you blend traditional retirement planning with, well, physical assets. Basically, a gold IRA is just an individual retirement account, but one that specifically lets you hold physical precious metals. We're talking gold, silver, platinum, palladium.
Right, so it's not just numbers on a screen, it's actual metals somewhere.
Yeah.
That feels different. What about this self-directed part? More control.
Exactly, it's tangible. And yes, it is a self-directed IRA, which means you, the investor, have more say over the specific investments compared to, say, a standard IRA mutual fund. But, and this is a big but, that control comes with very strict IRS rules. Like the metals have to meet specific purity standards. Can't just be any gold coin.
Okay, purity standards. And I've heard something crucial about where you keep it. You can't just stash it in a safe at home, right?
Oh, absolutely not. That's a huge point. The IRS is very clear. No home storage. No personal safe deposit box either.
Why is that?
It's mainly to prevent self-dealing and just ensure everything's above board regulated, which leads directly to the need for an IRS-approved custodian.
A custodian. Okay, so what role do they play?
They're essential. They manage the account, ensure compliance, and critically, they arrange for the storage of your metals in an approved, secure third-party depository.
Got it. So a layer of security and IRS oversight makes sense. All right, custody is clear. How about getting money into these accounts? Contribution rules.
Okay, contributions. Like all IRAs, the IRS sets annual limits to keep things tax advantaged. For 2025, if you're under 50, that limit is $7,000.
$7,000. And what if you're older, maybe closer to retirement and want to save more?
Yep, there's help there. If you're 50 or over, you get what's called a catch-up contribution. That's an extra $1,000 you can put in.
So $8,000 total for the 50-plus crowd.
Exactly. It gives older savers a chance to, boost their savings more aggressively.
That extra grand each year definitely adds up. Okay, so money's in. What about the growth? That's usually a big draw for IRAs. How does tax deferral work here?
This is a major plus, especially for something like gold, which you might hold long term. Gold IRAs offer tax-deferred growth. Simple as that. Any gains your gold makes, not taxed year to year.
So no capital gains tax hit every year if the value goes up?
Nope. The taxes are deferred until you actually take the money out in retirement. It lets the investment compound over time without that annual tax drag.
But this seems really powerful, letting it grow without constantly giving a slice to Uncle Sam. Especially with gold, where the value can bounce around a bit short term.
Precisely. That protected growth lets your savings build momentum much more efficiently than in a regular taxable account. You can ride out market waves over decades. And well, here's where it gets really interesting.
Oh, what's that?
Roth Gold IRAs.
Ah, the Roth option. Usually means even better tax treatment, right?
You got it. With a Roth Gold IRA, you contribute after-tax dollars, money you've already paid income tax on.
Okay.
The huge benefit. Qualified distributions in retirement are completely tax-free. Federal tax-free, that is.
Wow. So all that growth over the years comes out totally tax-free.
If you meet the conditions, yes. Like having the account open 5 years and being over 59 and a half, it essentially means potentially zero federal tax on your gold appreciation for your retirement years.
That is a game changer. Seriously, tax-free growth on physical gold. Okay, so we've got the gold in, it's growing nicely, tax-deferred or even tax-free in a Roth. What happens when it's time to actually use that money? Taking distributions.
All right, distributions. The magic number is age 59 and a half. Once you hit that age, you can start taking money out penalty-free.
Penalty-free, okay. But still taxed, I assume. for a traditional gold IRA.
Correct. For a traditional one, those distributions are taxed as ordinary income, so the amount you withdraw gets added to your income for that year.
Which could bump you into a higher tax bracket if you take out a lot at once. Planning is key there.
Definitely need to plan carefully. And what if you need the money before 59 and a half?
Yeah, what happens then? Emergencies happen.
Generally, you're looking at a 10% early withdrawal penalty, and that's on top of the ordinary income tax you'll owe.
Ouch. 10% penalty plus income tax. That's a hefty hit. Are there any ways around that penalty? Any exceptions?
Yes, the IRS allows a few exceptions, things like certain large medical expenses, costs for higher education, or a first-time home purchase, though there's a limit on that.
Okay, specific situations.
Right. There's also something called SEPPs, substantially equal periodic payments. It's complex, but basically you take regular calculated withdrawals based on life expectancy. If you do it right, you can avoid the 10% penalty before 59 and a half, but there's a catch. You usually have to stick with those payments for at least 5 years or until you reach 59 and a half, whichever takes longer.
SEPPs sound like something you definitely need professional advice on.
Yeah.
It really highlights how important it is to understand these rules before you need the money. The IRS keeps you on your toes. Okay, let's shift gears a bit, something that becomes really important later on. RMDs, required minimum distributions. What are they, and when do they start for gold IRAs?
RMDs, right. These are mandatory withdrawals. You have to take them. It applies to traditional IRAs, including gold IRAs, not Roths usually. The whole point is so the IRS eventually gets tax revenue on that deferred growth. The starting age used to be 72, but it was updated. Now it's age 73.
Age 73. So starting the year you turn 73, you need to take money out. How much? And what if you forget?
Rough.
Or just don't do it? I hear the penalties are rough.
They're very rough. If you fail to take your full RMD for the year, the penalty is a whopping 25% of the amount you should have taken out.
25%? Wow, that's huge.
It's a massive penalty. A quarter of the required withdrawal, gone.
So what does this all mean? It means you absolutely cannot ignore RMDs. You have to calculate it correctly and take it out on time.
Exactly. There is a bit of relief if you realize the mistake and correct it within 2 years. The penalty can be reduced to 10%. But honestly, the goal is just to avoid the penalty altogether.
Definitely. How is the RMD amount actually calculated for a gold IRA? Is it tricky with physical gold?
It's similar to a traditional IRA, actually. The IRS provides life expectancy tables, the uniform lifetime table, usually. Your custodian values your gold holdings at the end of the year. Then you divide that fair market value by the distribution period factor from the IRS table for your age.
So the custodian helps with the valuation part.
Yes, they have to provide the year-end fair market value, and they'll often help calculate the RMD amount itself. You just need to be aware that gold's value fluctuates, so that valuation needs to be done annually for the calculation.
Right, annual review is key. Okay, RMDs covered. Now, gold IRAs aren't just for the owner. They can be passed on, right? Part of an inheritance.
Yes, absolutely. They can be part of your legacy, but the rules for beneficiaries can be pretty complex. It really depends who inherits it.
I bet, like spouse versus kids, or maybe a trust.
Exactly. There are big differences. Spouses generally have the most flexibility. A surviving spouse can often treat the inherited gold IRA as their own. They might roll it into their own IRA, continue the tax deferral, delay RMDs based on their own age.
Okay, so spouses have options. What about non-spouse beneficiaries, like children?
It's more restrictive for them. They cannot treat it as their own IRA. They generally have a couple of main paths, depending on specifics. Often they need to take distributions based on their own life expectancy, stretching it out. Or, under newer rules for many, they might have to empty the entire account within 10 years of the original owner's death.
10 years. That can mean big withdrawals and potentially big tax bills concentrated in a short period.
It certainly can. It makes careful beneficiary designation and planning really important.
Good point. And all this tracking contributions, distributions, RMDs, value requires good records, right? What about IRS reporting?
Absolutely vital. And while the custodian handles the official reporting, you need to understand it. Accurate records of every transaction, buys, sells within the gold IRA are crucial. All this data feeds into the contribution limits, distribution taxes, RMD calculations.
So stay organized. What forms should people look out for from their custodian?
Your custodian is required to send you specific IRS forms each year. The main ones are Form 1099-R, which reports any distributions you took, and Form 5498, which reports your contributions for the year, and, importantly, the fair market value of your account at year-end. These are key for your tax return.
Okay, 1099-R for money out, 5498 for money in and value.
Got it.
Got it. This seems to loop back to something we mentioned earlier, but let's really clarify it. The custodian, why are they so critical? And how are they different from, say, the company that sells you the gold?
Right. This is a cornerstone of gold IRAs. The IRS requires an approved custodian. Could be a bank, credit union, trust company, brokerage firm specifically approved for this. They are responsible for holding the assets well, arranging the storage, and managing the account according to IRS rules. No self-custody allowed.
And the gold IRA company, the one you might see advertised.
They play a different role. Think of them as facilitators, maybe advisors. They typically help you set up the account, facilitate the purchase of the IRS-approved metals, and often connect you with a custodian and depository. They handle the initial transaction, basically.
So the company helps you buy it, the custodian holds it and handles the IRS stuff.
Exactly. The custodian is the entity ensuring ongoing IRS compliance. They secure the metals in that approved depository, handle the paperwork, the reporting. Their role is non-negotiable for the account to be valid.
That clarity is super helpful.
Okay.
Let's hit a few quick-fire common questions people often have. First, just to restate, gold IRA versus other IRA is the main difference.
The asset. Physical precious metals in a gold IRA versus paper assets, stocks, bonds, funds in most traditional or Roth IRAs. It's about adding a tangible asset class.
Simple enough. Can you move money from an existing IRA or 401k into a gold IRA?
Yes, definitely. It's done through a rollover or transfer. Super important to follow the rules, especially the 60-day rule if you do an indirect rollover, to keep it tax-deferred and avoid penalties. A direct custodian-to-custodian transfer is usually safer.
Good tip. What about income limits? Can anyone contribute?
For a traditional gold IRA, generally, yes, no income limits on making contributions. But for a Roth Gold IRA, yes, there are income limitations, just like regular Roth IRAs. If your income is too high, you might need to look into that backdoor Roth strategy we sometimes hear about.
Right, Roths have income caps. And finally, let's just hammer home that RMD penalty one more time, if you miss it.
It's that painful 25% penalty on the amount you failed to withdraw, potentially reducible to 10% if fixed quickly, but really the goal is 0% by just taking the RMD on time. Don't give that money away unnecessarily.
Absolutely. Avoid the penalty.
Well, what's fascinating here is just how much these IRS rules shape everything, isn't it? From how much you put in, how it grows, how you take it out, those RMDs, the custodian's role. It all defines the potential and the responsibility of having a gold IRA.
It really does. It's a unique tool for diversification, but it absolutely demands that you pay attention to the details of the tax code.
And this deep dive, drawing from Doug Young's research, really underscores that. You need to be informed. As you think about whether this fits your own strategy, remember Doug Young also emphasizes comparing the actual gold IRA providers, not just the concept. His research often looks into those comparisons.
Good point. And of course, our usual reminder. This discussion is for educational purposes. It's not financial advice tailored to you. Please always talk to a qualified financial advisor who understands your specific situation before making any investment decisions. Couldn't agree more. Always get personalized advice. So, as we wrap up, here's something to think about. Given how financial markets and, importantly, tax laws are always changing, how do you personally balance the appeal of something tangible like gold in your IRA, that sense of security, with the very real need to constantly stay vigilant and adapt to the shifting rules that will impact your retirement plan over the long haul? It's not just about buying the gold. It's about managing the whole picture year after year. Thank you for joining us on the Deep Dive. We hope this leaves you feeling more informed about the intricacies of gold IRA taxation. Until next time.